Hello and welcome back to The Note, which is going to be coming to you for the next few days from Seattle, Washington, where I'm covering the CFA Institute annual conference. We're starting today with interviewing one of the heroines of the great banking crisis of 2008, or at least that's what many people say. Well, if you read her new book, you'll discover that she herself felt that sometimes like a skunk at a garden party. So I'd like to introduce Sheila Bair, the former head of the Federal Deposit Insurance Corporation. Sheila, to start off with an impossibly big but shortly made question, why did the crisis happen? What were the mistakes made that allowed the crisis to happen?
Well, if I had to pinpoint one thing, it's leverage. It's leverage fueling an asset bubble in housing. Banks were too leveraged, lenders were too leveraged, borrowers were too leveraged. And if you look throughout history, pretty much any financial cycle is caused by speculative bubbles fueled by too much leverage.
Now, what kind of regulatory changes might have prevented that bubble of leverage from
Well, we shouldn't, as home prices were escalating, we should have been increasing bank capital requirements. Instead, the FDIC was fighting off this Basel II Accord, which actually would have lowered capital requirements against mortgage exposures, which was lunacy. And the investment banks adopted it, the European banks adopted it, and as a consequence, they had much thinner capital cushions when the crisis occurred. We needed mortgage lending standards that tied the making a loan to the ability to repay. Once you disassociated the ability to get a mortgage from the ability to pay for that mortgage, you severed the relationship between wage growth and housing prices. And so, of course, you were going to get a bubble. It dramatically increased demand. If you didn't have to document income, put anything down, it was ridiculous. And then derivatives. We decided to not regulate derivatives at all. Not only that, but Congress passed a law telling the regulators that they, hands off, don't touch OTC derivatives. And so when we got into the crisis, it was very opaque. We didn't fully understand the exposures. It turns out there was an institution called AIG that was who was the dummy holding the bag. That was AIG. He had written a lot of credit default swap protection on how mortgages were going to perform, which obviously they were on the wrong way on those.
Now let's move on to the actual events of the crisis itself. And one fascinating tidbit that comes through from your book, which few people would have realized, is that the institution that inflicted the most losses on the FDIC was IndyMac. Take me through what happened at IndyMac, and also, is there any relevance to the argument that some people make against deposit insurance, that it adds to moral hazard, that it would be better to make depositors be the ultimate arbiters of a bank's health? Right.
Well, certainly insured deposit insurance adds to moral hazard. That's why you have a regulatory structure to counteract those. It's too easy for banks, arguably, to get funding with insured deposits. So that's why you need a robust regulatory process. We did not have that with IndyMac Bank. It was regulated by the Office of Thrift Supervision, which has since been abolished by Congress. What they did was they used broker deposits. They paid high rates to track broker deposits, which had deposit insurance. And then they used that money to make really bad mortgages. And yes, an institution like that is going to have very severe losses for the FDIC. That said, though, I think you need to look at the broader context of the crisis. Those who got in trouble, the institutions that were big drivers of this crisis, were not insured deposit funders. AIG, Lehman Brothers, Bear Stearns, Merrill Lynch, Citigroup even. Citigroup, a $2 trillion institution, only had about $125 billion of insured deposits. They funded in something called the wholesale markets. They basically were borrowing from other financial institutions. They were really ones that drove us into the ditch.
Okay, and that basically created the modern version of a bank run in a form that didn't involve deposit insurance.
And what they call the shadow sector, which is for non-deposit funding, wholesale funding. Yes.
Now, let's move on to the critical issue of how do we stop a crisis like this happening in the future? What are your main prescriptions for what we need to do to fix this?
Well, much higher capital requirements for banks and institutions in the safety net. We've made some progress there, not nearly enough. We also need regulation to make sure that when banks lend to others, that the borrowers are not using too much leverage, whether that's a hedge fund, a PE fund, a homeowner, what have you.
Keeping that leverage from finding its way into the system.
That's right. So you need to make sure the banks aren't borrowing too much, but you need to make sure that those who are borrowing from banks are not over-leveraged as well. We need better oversight of derivatives, more transparency. I argue for banning speculative use of the credit default swap instrument. I think it's gambling, it's insurance, it should have an insurable interest. you couldn't buy a fire insurance on my house because it would give you an incentive to burn my house down. And it's the same way. People shouldn't be buying credit default swap protection against people defaulting on their mortgages. It gives, or excuse me, that will encourage them, that will let them make money. When people default on their mortgages, and that's what we had, a lot of the big CDS investors who were short what's called the ABX index actually wanted people to default on their mortgages because they made more money. So I would ban speculative use of CDS, only let it be used as insurance where the purchaser of the protection has insurable interest.
Now what's interesting about this is that quite a lot of the things you're calling for haven't
happened. That's right.
You yourself said there were obvious disagreements which many of us on the outside knew must be going on.
Right.
You yourself described yourself as feeling like a skunk.
Yes, I was.
And you in particular have some criticism for Tim Geithner, who was both the head of the New York Fed and later the Treasury Secretary during this. Why precisely have we not tackled some of these issues 5 years on?
Yeah, I don't know why. I mean, we have made some progress on capital standards, but not nearly enough. The securitization market, another driver of the crisis, we really haven't reformed. It's money market funds, which prove themselves to be very unstable. We haven't reformed. So
what about the size of the banks as
well?
The
size of the banks, I think it's more complexity than size. There has been a little bit of simplification of legal structures, a little bit of downsizing at B of A and Citi, but for the most part, not as much progress there as needs to be. We've gotten their capital levels up, but they need to simplify their legal structures. They need, in my view, they should at least silo their different business lines. So you keep the commercial banking operations and the insured deposits away from the other types of.
Known as that in the
yes, I like that model. I like that model.
But why precisely is it? Is it due to the political influence of the banks, or how have they managed to avoid?
I think there's something called cognitive capture, the tendency of regulators, no matter how hard we try, to look at the world through the eyes of the institutions we regulate as opposed to the broader public interest. I think that's something regulators have to constantly fight against. Yes, there's been political pressure from Congress, too, to back off in certain of these areas. I think that's very unfortunate after this terrible crisis that we're still seeing that. But more importantly, it just seems lack of resolve. Yes, the industry is lobbying relentlessly against any of this, any changes at all, pretty much, except just little tinkering. But the regulators have not had the fortitude to stand up to it and just say, we're going to get this done. If it's going to cost you money, too bad. This is what we need for a stable system. We haven't seen that kind of resolve, unfortunately.
Okay, Sheila, thank you very much for that. It is a shame we haven't seen such resolve. For those who are interested in this, also try reading Bull by the Horns by Sheila Bair, which is a very, very interesting book, and particularly after you've read it, you might also be wanting to read the book, which I gather is going to come out quite soon, by Tim Geithner.